Hey everybody, PJ back with another video here for Exotic Car Hacks, and today we are not in my garage and we are talking about more technical terms around car hacking and a step-by-step guide to understanding what it really entails and is it particularly for you or not. Now, too long has the mainstream media been brainwashing people that financially good decisions are made very far away from cars, as cars have been seen as liabilities, and for too long have we looked at liabilities and said, oh, my car is an extension of my losses, not of my gains, right? And so since 2005, I've created investment portfolios that included cars. And so a lot of people thought I was crazy back then, and I've been doing this for quite some time. And today, as I'm teaching you here, this new car hacking methodology that is basically the foundation for what allowed Exotic Car Hacks to exist. And if you don't know what that is my community, which you can reach by just clicking the link in the description, where it'll take you to a free training on a more extensive version of this to see if you can join our community or not. Now, let's break down the conventional thought of a person buying a car, and then we'll compare that to a car hacker and how that varies. So the conventional person typically buys a car on two bases. The first one is monthly payment. How much can I afford? And then down payment. So I would say probably 80% of America buys cars on these two things. Do I have enough down payment? Can I afford the monthly payment? This is where the brainwashing gets really good. If you're looking at a liability, then it would make sense to say, well, this should not exceed X amount of your income, and so on and so forth, because if you make $10,000 a month and you spend $4,000 in your car, it's probably a bad idea because you're losing $4,000 out of your money. In a conventional thought, that makes sense. Now, even further to enhance your stupidity, the government has added an incentive, which is, hey, we're going to turn this idea into what we call a lease. And the reason we're going to do that is because while you think you can't afford that $2,000 a month payment or something, we're going to allow you to lease it, which is even better for you. And you're like, why is it better for me? Because if you own a business, I'm going to allow you to write that off and get some of that money back. So you're like, well, this is excellent. I can write off that whole payment? Yeah. So technically, you'll get taxed less at the end of the year. Well, that's a no-brainer now. I can afford the car I want and get a tax write-off. Well, wouldn't that be fantastic? I'll probably end up really losing maybe at the most 60% of that payment, not the rest, because that'll be my basis if I'm a business owner and I can do that. So where the issues realize that all of this methodology is focused on the idea of loss and minimizing loss. Which you see, like the original monthly payment and all the memes on the internet about good financial advice is about 10% of your income, 5% of this, you should be able to afford in cash your debt and this and that. Well, that doesn't matter, it's stupid, right? It's completely stupid because everything is built around how badly do you want to lose. It's like you're coming into a game and you're like, you're going to get your ass kicked in this boxing match. How badly do you want to get hurt? And you're like, I guess as little as I can. Okay, well, wear this headset, and Mike Tyson's only going to knock you out 80%. Why are you laughing, Reggie? Why you see, you can't even like bust out jokes.
That's right, I can't help that.
Okay.
I'm sorry.
Anyways, so the point here is that the lease is basically the helmet, and getting your ass kicked is still the equation. Like you're going to get laid out and knocked out, right? So that's how the entire universe looks at the car market. Now, it's a little bit different when you look at cars that are depreciating. Like if you're buying a BMW 3 Series, if you're buying a Nissan Altima, if you're buying a Volkswagen Jetta, these cars are continuously going to be worth less money year after year because their depreciation graph basically starts here and goes to the toilet. And it goes to the toilet for one reason, because they keep making better shit. Like nobody that buys a Volkswagen Jetta want a 10-year-old car when a new Jetta is out. Why are you still laughing?
I'm not.
Yeah, but you're like crying.
I'm just trying not to.
Okay, anyways, so we're back to this. The point is, nobody wants these Jettas. And the reason they don't want them is because people don't buy Jettas because they love Jettas. They buy Jettas because they want to get from point A to point B. And to get from point A to point B means that you're looking at a vehicle as an economical way to take some mediocre level of pleasure while driving from point A to point B. So you have leather seats, CD, Bluetooth, and all that crap. That doesn't really matter. And each and every reiteration of the car is better. It gets better gas mileage, it's more comfortable, it's more quiet, it's faster. But the experience doesn't change. It just enhances it just enough for you to be like, that new Jetta is really nice, so I'm going to go trade in my car. Well, if you have a lease, they make it easy. You just turn in your car, get the next car, and continue the bloodbath. So you're basically like, hey, I got my ass handed to me, and I'm completely knocked out, and while I'm bleeding in this helmet, give me a new helmet so it's not bloody, and I'm going to get back in the ring and get my ass kicked again. And you do this over and over and over until you're basically financially dead, which is why cars have a really bad rap of historically just being depreciating assets. But, as I always say, not all cars are made equal. Someone who buys a Ferrari, a Lamborghini, and a Aston Martin is not buying a need to get from point A to point B. They are buying a want. And the beauty of a want is that it is much stronger than a need, and it's also not something they have to continuously change every year to continuously be happy with their want. So here's what happens. Every generation of an exotic car has its own followership, right? So which makes, and I'm not going to go too much in details there, the new graph here for exotics, instead of being like a normal car going down like this, right, like we just saw in the Jetta, instead the way it works is while it goes down here at first, it stabilizes over time and then eventually starts to trend back up. So the point that I'm trying to make here is the graphs are significantly different when you have a car that is focused on a want versus a need down here. These cars right here, which are your day-to-day cars, your Lexuses, even nice BMWs, are a need. The wants here, the ones that basically are taken care of and treated like they're part of your family, those wants don't depreciate as hard. And they don't for a couple of reasons. Because they don't make that many of them. So usually supply and demand meet at a point where once the supply is shortened, then the demand stabilizes. And once the supply completely is non-existent out of production, it goes up because no new supply is introduced, but demand stays the same. The big equilibrium in economics here is that with exotic cars that are wanted, supply chains start and will depreciate based on a sheer number. Demand will meet that supply and will stabilize that. But as production ends, like as they stop making a Medina, go to F430, as they stop making an F430, go to a 458, this production ends and new demand enters the market all the time, but more supply doesn't. And what happens is with every new model, the new price point is always higher. So it always leads us to graphs that follow this on the next level. This is what we call a stack. This stack allows us to understand that each model carries its own depreciation cycle identical to the previous one. If a model carries the exact same attributes as the previous one, the stacks are very clear. So it goes like this. This is car 2, this is car 3, this is car 4. So these stacks are equal, they're just new generations. So as an example here, just so you understand what we're talking about, and you're not confused, this would, for example, be a 458, this would be a 430, this would be a 360, this would be a 355. Same car generation, just across the board, at different price points, but cohesive to each other. If the 458 moves down, so will the 430, so will the 360, so will the 355. So these types of very interesting, wait, where did it go? These types of very interesting stacks allow us to basically predict car values, future, current, past, and use all that data to determine something. So how does or why does car hacking work? So let's look at the fundamental economics of it so that we understand how the money flows through things. In a normal conventional way, you would pay $450 a month for a lease, right? So this is a car that I can't even spell. Okay. So this is a car that you lease. You pay $450 a month, and that money is basically gone, right? Now, in a hack methodology, this is not the same car, but let's say you wanted to have a nicer car, usually about 10 times as nice. As an example of this would be a $450 a month lease. Wouldn't even, make sense right now because in the market we're in, you're probably at $750. Let's use this for maybe a specific Range Rover so we can use, what's a Range Rover lease right now, I think? Let me just look this up real quick. So, okay, 900, we'll use that for a base model, right? Okay, so 900 a month, and this is for a base model, okay? So a base model will cost you 900 a month and somewhere around like 20,000, whatever, down after your taxes and all that shit. So this is a very small lease model, right? Each month you pay this, it's gone, and by the end you paid your 36 payments times 900, and you added your $20,000 down payment, and you can change my figures to anything you want based on any lease deal you find, so it's not that hard. Why don't you want to look up what 36 times 900 is, so we can do that, and I'll come back to this in a second. And then this is basically your lease payment. Now, in a hack model, you could have, this is a base Rover with an MSRP of like 75 to 90K. And here for the hack model, you can have the SV autobiography with 150 to 180K, which is 2 times the money, right? And this is, Reggie just showed me because my math stuff. Wait, did we 36 times 900 plus 20?
Oh, plus 20.
Okay, so it's 52? Okay. So that's 52,000 basically. So 52,000 of your money in your lease disappears, and then you turn in the car. Now, the reason this is exciting is because most people go, well, the car's going to depreciate more. I bought it for 90 new. I lost 52. Well, I didn't lose the other 40. Well, you technically did, because the car, remember, once it hits a certain mileage, doesn't depreciate as fast. So as soon as the car got good, you basically handed it back to the dealership, and you took a 52K loss. Even if you take, let's say, a 30% benefit on taxes from a lease standpoint, this liability somewhat, in its best case scenario, still comes around 35 grand. So it costs you 35 grand basically, which is $1,000 a month in essence to drive, assuming you have a tax write-off. If you don't, it costs you more, right? The point I'm trying to make here that I want you to try to understand, that's just really important to understand, is that here you're getting an SV autobiography, not a base model. And your payment, however, could be more because you don't have a lease, right? So it could be $1,400 a month. Well, you would argue, why would I want to pay $1,400 a month when I can pay $900? Well, there's 2 arguments here. One, you're getting twice the car, not twice the payment. That's step 1. 2, the other part you have to understand is, let's assume you did the same $20,000 down, right? So can you do that on the calculator real quick, Reggie? What's $1,400 a month? And let's say we're going to do that times 36 months. And we're going to add that. Dun, 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 dun. Dun, 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 dun. Da, 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 da.
70,400.
Okay, so 70,400. Okay, 70,400 versus 52,000. And no tax write-off, right? So obviously it seems like the lease is better to save money. But is it really? Because let's look at this. The depreciation schedule on this basically goes 50% of value instantly. But the depreciation on this, because it's been hacked with the right methodology to buy, not just by buying something expensive, but buying the right one at the right price, because we're not paying this for a hack. And that's the key. You see, for this particular car, we're going to pay somewhere around $120,000. And one of the best parts about that specific thing is I want to show you the graph difference between the two. This is the Range Rover that you lease. This is the Range Rover that you hack. So when you lease a car, you're buying this to this. You're buying this. When you hack a car, you're buying this. So this should be clear. This is a hack. This is a lease. You see something going on here? Down, up. The hack is a hard-on. The lease is a letdown. Right? It's like up, it's like down. So the lease is a total loss of the worst depreciation of a car, and the hack is a purchase at the most stable appreciating part of a car. So when we come back here now, here is the angle. You paid $70,400 for this car. You paid $52,000 for this one. This is your $52K loss. So hint, liability, if I can even write this, whatever. So this is a liability, okay? Here is your hack. Now, going back here, $70,400, right? But if it's going up, here is the ultimate question. Did you lose it? How could you lose $70,400 if the car's going up? Well, here's what you did. You see, because I created a proprietary strategy called WT, which stands for wealth transfer. And here's how it works. You took money, this is your bank, okay, and we're going to give it some windows. It's an ugly ass bank, sorry. Okay, this is your bank. I'm going to write bank here. Okay, and you put money from your bank to your car. The difference between the lease model is you took money from your bank, you put it in your car, and your car blew up. Basically, everything ended, and the car's gone, and you replaced it. But with the hack, the money you put from the bank to the car actually stayed in the car, almost like its own savings account. So what you really did was you transferred wealth from your bank account monthly and your down payment into your car. Now your car is using tires and is running around and is being used. That has some type of mileage cost. And if you're following the hack methodology, it's a very low mileage cost. But it does have some type of cost. Here's the argument though. That entire transfer here, we just saw it here, right, was $70,400. So you basically transfer $70,400. And your car may have consumed over 3 years maybe $10,000 of that, which was in tires, oil services, not gas, but because you're going to pay gas no matter what you drive, right? Not insurance, because you're going to pay insurance no matter what you drive. And believe it or not, this is some big misconception. The insurance on a 200K SUV and a 100K SUV, because they're the same brand, is identical. So if you thought, oh my God, that one's going to be so much more expensive, it is not. If you follow any of the stuff I teach, it's not at all. So the point here that I'm trying to make is that $10,000 of your money is basically gone. And this is for the usage, right? Which would have also been gone in addition to this other model. So technically, in this model here, the $52,000, we're not talking about maintenance either, which is separate, right? No different than here. But let's assume now your car has maintenance here, just like the other one. Here, you have a $10,000 loss from that. So technically, your bank account that transfers $70,400, right, just moved to $60,400. Correct? But here's the reality. That still sits in the car. So when you sell this car back for the $120K you paid, because that's the beauty of it, a hack can be driven for years with fair amount of miles at it and the dollar value doesn't change. That's how we pick the cars. Now you sell it for $120,000. So let's actually give you an even worse scenario. I'd say you even sell it for less. You lose $10,000 because you weren't very good at this. And you still picked the right car, but you weren't a good negotiator. You lost $10,000. This means that you lost $10K out of your original $70,400, which means $60,400. Okay, $60,400 was actually back in your pocket once you pay off your loan. If you took out a bank or you paid cash, doesn't make a difference. Because that money you paid, even if you had a loan, went into the car. And now it's back into your pocket. Because when you pay off your loan, if you have a 150K loan or 130K loan, and you pay off, for example, let's say your other 60 because you paid down your loan, right? In 3 years, you paid some payments towards that loan, you put a down payment. So your balance is like $50,000. You have $110,000. You get back $60,000 of your money. So what happened is you really spent $70,400 over 3 years, but you got back, let's say $60,000. That gives you 10,000, that gives you basically a 10,400 loss. So Reggie, take a calculator, type in 10,400 divided by 36. And the magic number is 289 a month. Even if you factor in the interest you paid on your loan, because interest rates right now are like 2% on a, I just want you to understand this. Even if you factor that in, let's say you're at 350. The difference between hacking is you threw away 900 a month. Remember, after your tax write-off, you threw away 900 a month and you drove the crappiest base Rover you could find. Or you used $350 a month to drive the most epic, insane SV Autobiography Range Rover ever. Because you see, one of the big problems is that we've been brainwashed to understand money based on us with an emotional reaction. What can I afford? What can I buy? What is the right thing to do? We have been trained, conditioned to basically look at money based on make and spend. We haven't been conditioned to preserve, because that's not how economies work. Economies work better when people spend and buy and the money keeps exchanging hands. It doesn't work well if everybody left their money in their savings account, didn't ever buy anything, but we would also not enjoy things in the world, right? So with this methodology, you're basically transferring money from your bank to yourself, to your car, to your house, to all of these things. And the point that I'm trying to make here is that as long as you're buying assets that don't depreciate, then it doesn't matter. And so what I'm trying to basically get you to understand, that hacking methodology is about a couple of things. Good finance. Now, what does that mean? Does that mean that you have to be incredibly rich? No. Good finance means no emotions, rather just money. This is important to understand. This isn't about what you like, what you lease, what you can afford. It's about understanding money for what it is. And what I want you to understand is this very simple thing right here. A $350 loss, even though you had to invest $1,400 a month to get there, is significantly better than a $900 a month loss when it's to crap your car. Even though you didn't have to make an investment of $1,400, you only made an investment of $900 and lost $900. Here you made an investment of $1,400 and basically lost $350. But you got a way better car. And the other angle, you couldn't even lease a Jetta for that. You couldn't even lease the base model Kia for that dollar amount. But you got a $200,000 Range Rover. So good finance, no emotions. That's key, like key. This is a financial concept, not a car concept. The second thing, not all cars work. A lot of people believe that hacking is about, I can do this with any car. Yes, you can use the methodology on a lot of cars, but it won't give you the same results. If you use it on a base Range Rover, you can lower your cost of ownership, but you're still going to eat it. If you use it on the right Range Rover, if you use it on the right Ferrari, on the right Lamborghini, on the right car, then it will work brilliantly. There are cars that have made me $100,000 a year just for owning them. And there are other cars that have cost me $200 a month for owning them. Every one of these cars is something someone else would dream of owning and thought they had to work 10 years to save up to afford. So not all cars work. So this is something important to understand, right? And here's the other part. We follow data. So you see, at Exotic Car Hacks, in our community and course, I continuously upload data on all of these different cars so our members can basically understand the data and then choose for themselves what makes sense for them based on what they're willing to risk versus invest versus lose, and so on and so forth. So they're able to basically make calculated, non-emotional decisions around which cars to buy, which cars not to buy, which cars to basically go into, and which cars based on periods of time are under which depreciation graphs that make sense, and so on and so forth. So this is the core concept of hacking. It's the idea of following data, not on every single car, and understanding that emotions play no place in money. So if you can literally follow these rules or accept these rules, then you should join us at Exotic Car Hacks and learn how to do this, because this will completely transform your mentality around luxury goods and will put you in a place of getting out of the consumerism that has been literally brainwashing you for the last 20 years into thinking that your finance education should come from memes on the internet. Really, your financial education should come from a basic concept and understanding that not all assets are created equal. And one of the key things I've said to people over and over and over, one of the biggest ways in America segregation of wealth keeps getting worse and worse is because poor people don't own anything and rich people own things. And during inflationary periods or recessionary periods, assets go up in value. And when assets go up in value, those who own nothing get nothing. And their dreams get way further from them than others who have done something and own something, and their dreams rise with them. So the distance between themselves and where they want to be in life does not get larger to a point where they cannot accommodate it. This is why Exotic Car Hacks is a financial course, and this is exactly why you need to click the link in the description and join Exotic Car Hacks so you can learn to completely change your mindset on how cars, hacking, and everything in between works. So hopefully you've enjoyed this. If you want more content like this, please like, turn on notifications. Let me know in the comments if there's something that still confuses you about car hacking so I can explain it a little bit further. And remember, at the end of the day, the investment you make in your own education is what is going to enable you to take that return back 10, 15, 20 times over, because you're able to use these strategies on every car you buy going forward rather than just on one car, your next car.